Hello once again and welcome to the show. Successful people make success look easy, don't they? How many times have you heard, or in fact how many times have you said of a successful person, he or she is lucky? Luck has little, if anything, to do with success.
As an investor, you will struggle to purchase a property. It's potentially through those properties that you're missing out on that will then drive fear, frustration, and disappointment, and all the range of emotions that you're missing out on all these great opportunities.
That's experienced self-made investor Azeem Rahman, who's amassed a $3 million property portfolio over the last 8 years on the strength of his own determination, his grit and perseverance. Today you'll hear Azeem tell Bushy about his journey, about the challenges he faced and the decisions he had to make along the way. Also today, Jo-Anne Oliveri delivers a sobering message for investors who could in fact be cutting off their nose to spite their fate. That's coming up later in the show. Before we start, I want to thank our supporters and content partners realty.com.au, BMT Tax Depreciation, Know How Property Finance, Get Rare Property and Apiro Marketing. And you'll find us on all podcast players as the Property Hub. Also on the Southern Cross Stereo Network, Hot Copper and all social media platforms.
Property deductions can save you thousands of dollars each year. To make sure you maximise deductions, you need to work with the most experienced quantity surveyor in the country. BMT Tax Depreciation is the leading specialist in the industry. They've completed over 700,000 tax deduction schedules for residential investment and commercial properties Australia-wide. BMT guarantee to find double your fee in the first full financial year deductions. Call BMT on 1300 728 726 today for an obligation-free quote. Realty Talk and your host, Bushy Martin.
Now, it's fair to say that most of us have been surprised by the very high competitiveness of property conditions around the country since the beginning of the year, with many markets running hot and unsuspecting investors finding it increasingly difficult to find and then secure good properties in growth areas. So how can you better overcome this? Well, to shed some much needed light on this quite timely topic, experienced self-made investor Azeem Rahman, who's amassed a $3 million property portfolio purely on the strength of his own determination, grit and perseverance over the last 8 years, joins us now to share his winning tips for buying property in hot markets. So welcome to Realty Talk, Azeem.
Thank you very much, Bushy, and it's a pleasure to be on.
Looking forward to having a chat, and it's great to talk to someone who's rolled up the sleeves and got their hands dirty with it. But I guess just to sort of set the tone for the subject, what do you define as a hot seller's market?
Yeah, it's a good question. So I think, Bushy, for me, a hot seller's market is one where there is essentially a tremendous amount of attention being channeled through into one specific suburb or region. And it's that attention that actually drives the value of the properties in the short term, and potentially at times, driving overvalued property prices as well too. So that's what I refer to as a seller's market. And in addition to the short-term capital gains that the owners are going to reap who are selling at the time, existing property owners within that suburb as well too who are not selling, they also are going to be enjoying and reaping additional capital growth that's happening at that time as well. From my experience, there's 3 key things that really drive so much attention into a particular area or a particular suburb. It's definitely one, investors who are following the data.
Yep.
High volume of buyers agents who have strong relationships with sales agents within the local area, and definitely media as well too. Particularly when they're not painting a doom and gloom picture about the property market.
You make a very good point, and I think we've gone from sort of no information 20 years ago to way too much information now. And in the AI age, where people have got instant access to a lot of data, I'm certainly seeing a lot of buyers agents become market makers, very much like the stock market, where they're all coming to the same conclusion, so they're all piling into that location, and by virtue of that, driving up the values because they're all competing with each other for the limited properties that are on the go. So it's an interesting exercise and a bit of a change in the way the market's actually working from that perspective. But that, of course, create some challenges. So I'd love for you to sort of unpack what are the challenges of trying to buy properties in high competitive hot markets, and what are you seeing and experiencing in this regard?
I think there's two key challenges. The first challenge is that you will, as an investor, you will struggle to purchase a property for the price range that you have in your mind in a hot market. And it just creates a domino effect, right? So I think a hot market leads to more competition, and more competition then leads to potentially more properties being missed out by you. And then it's potentially through those properties that you're missing out on that will then drive fear, frustration, and disappointment, and all a range of emotions that, you're missing out on all these great opportunities, which could then in turn drive you not carrying out your due diligence properly and cutting corners, or offering above and beyond what the actual genuine value is of the property. So I see it actually plays out in quite a domino effect in that place. So I think that's the first challenge, is not to get yourself in that position, because it can be very risky and dangerous, particularly from a bank valuation perspective, because you can still get it wrong even in a hot market from that perspective. So I think that's the first challenge. Yep. And the second challenge is that a hot market can't actually sustain that price growth for the long term. And I think that's something that a lot of investors, particularly who don't have a large portfolio and don't have a lot of experiences doing themselves or getting the assistance, don't actually appreciate this concept, that the challenge is that if you already are looking to purchase, you're not actually going to be getting a much longer period of short-term capital growth that you think you'll be getting. Yeah. And a lot of this is actually being artificially driven by buyer's agent as well too, who are continuously trying to drive the short-term growth in a particular market, which is fine for that point in time, but the pinch is felt by the investors when the market goes through a bit of a natural correction.
Yeah, very good point, because we all know that locations go through the old S-curve of growth over a sort of average 15-year period. And you don't want to be buying a property and jumping for joy for the first year and then seeing the value flatline for the next 5 to 8 years and not see any growth. So, so some lessons there. Now, you've written a really good LinkedIn blog that gives your suggestions on some winning tips to secure properties in hot markets. I'd love for you to give us a bit of a quick dot point summary of those, and then I'll break down some of the key ones.
Yeah, absolutely, sure. So I think the tips that I've shared in my article is, number one, you need to be patient and persistent. Even in the best circumstances, you will not be able to purchase a property overnight. So give yourself the time that you need to do it well. Two, have your finance pre-approval ready to go. It sounds very logical, but many investors still don't do this. Number three is to set your alerts so that you're very clear on the type of property and the price range that you're looking at, so that when something does hit the market, you're ready to pounce on it. Another tip is to have your team ready to go. So when I say team, I'm specifically referring to all the people that need to be involved and play a crucial role in the purchase of the property. So your mortgage broker, your property manager, conveyancer, building and pest, and potentially a buyer's agent as well. Factoring indexing during valuation, I think, is very important to do, specifically in a hot market. Don't compromise on due diligence, which we kind of spoke about a little bit earlier too. Get a gauge from the selling agent by asking them some good quality questions. Negotiate terms, which I think is important to do at the contract stage. And lastly, look for cooler markets. Try to go against the tide and look for areas that aren't hot, but eventually will be down the track.
Some absolute gold on those tips, and I'm going to suggest that everyone jumps on their LinkedIn page and has a read of that blog, because there's some really good discussion on it. But let's break into a couple of the key ones there. And firstly, I'd like for you to expand a bit more on what you call factoring in indexing during the valuation. Can you sort of break that down for us?
Yeah, sure. So indexing, in simple terms, is where you adjust the recent market comparables, typically from the last 3 months or so, for any price increases that are occurring within the suburb, which won't actually be reflected in the data. So what I mean for that, so just to keep it simple, for instance, you might be looking at recently sold properties for, say, for a particular configuration, which is showing that for the last 3 to 6 months, it's been average selling price is about $500,000. However, if we come to the current period, you may have seen 5 to 6 properties sold just last week for $525,000. right? So those properties that have just sold within the last week, they won't, majority of the time, actually be reflected in the data. So each property that is being sold is a data in itself, and that actually won't be reflected immediately. That typically takes anywhere from 1 to 2 months, which is when the property is actually settled. So if you are not factoring that in and you're just looking purely based on the fact black and white and saying, okay, the last 3 to 6 months has been selling prices about 500, and you go with that mindset in mind when you put in an offer for a property, chances are you'll continue to miss out, which kind of talks to what I was saying earlier, is where that frustration will come into play, and the disappointment and the fear of missing out. Where in actual fact, if you just apply a little bit of indexing and actually factor in that it's actually going a little bit above, which is $25,000 in this example, then you're actually in a better position to not only put in a good offer in place, but increase your chances of actually securing that property.
Very good advice. It's the old story of continue to look through the windscreen, not through the rear vision mirror. Because and I know, really good quality data sources like CoreLogic, they will give you instant valuations on what they think the property is, but it's on the previous historic sales data, which is often out of date. So an easy trap there, and very good advice on that. I'd love also to get your thoughts on how buyers can ensure that they don't compromise on due diligence in hot markets, given the speed that things often have to happen, or the pressure that's applied to them by selling agents and others.
Yeah, so I think from my perspective, you should never compromise on due diligence. Period. So it is never worth cutting corners in that regard at all. I would never do that at all. But what you can do is sort of be a bit more efficient with your time, and have, like I was saying earlier, have your team ready to go, so that when you need to pounce an opportunity, everyone can fire at the time that you need them to do. So when I talk about due diligence, I'm specifically referring to your building and pest inspections, your finance, and your contract reviews. And the suggestions I have is, number one, as I said, spend the time and speak to all the people that you need to get them ready, so they know that you will be getting in touch with them in another couple of weeks' time or within a month's time, so they're ready for your phone call. Your building and pest inspection in particular, when you do receive that, read it and actually try to understand what's in there and ask the questions. There's no such thing as a silly question. Your property manager, have someone on the ground to actually inspect the property, particularly if you're looking interstate, and make sure you have all your finances in the contract, just in case there's something that happens that's unforeseeable, and you decide that this is actually going to be a deterrent for you or restrict you from going ahead. You're actually protected by your clauses in place.
Great advice, and sort of reinforcing a couple of the key ones you've made there. I think a good conveyancer will actually review the contract on your behalf. They read them all the time. So as you say, if you've got them lined up, then get them to go through the contract terms and break it down into simple English, so that you know what you're actually committing yourself to. But also the property manager, I 100% agree. Getting a good, independent, dedicated property manager who's not a part of a sales team, who can actually knows the area, knows the property, knows how it compares to others in the location. That intimate local knowledge is worth a lot right up front and early. So getting that done before you then made an offer on the contract is a really key part of it. So some great thoughts there. Lastly, I just, because one of the points you made was starting to think about cooler markets. Can you share your thoughts on looking at this? Because I think this is a really key point, given the market conditions that we've talked about previously.
Yes, I think this is the tip that I don't see is mentioned enough, at least certainly from my perspective, which is to look at cooler markets. So contrary to popular belief, there are data-driven methods to identify and analyze suburbs and regions which will be poised for growth and become what we call as a hot market down the track. But the only way that you can actually do this is, as I said, by looking at the data. So there's a few key things that you need to look at. Personally, I look at days on market, I look at the stock on market, online search interest ratio, and the demand to supply ratio. But the key thing, Bushy, and for anyone who's listening, is it's important not to just look at the current static figure and the metric, but it's the trend that's very important. And not only do you need to look at the trend, but it needs to be positive and encouraging. If it's not a positive and encouraging trend, then I wouldn't be confident to look at that suburb and say hand on heart, okay, this is a cooler market that's on the rise. But if it does, then it would give someone more confidence to be able to say that, and myself as well too. And in addition to the trend, there needs to be some level of price growth occurring as well too. So if you have a look at these metrics and it actually makes sense to you, yep, okay, everything is heading in the right direction, looks good, thumbs up, but there's actually stagnant growth, or in fact, the growth actually is going in the reverse. That's also something that you need to keep an eye for. There needs to be some level of price growth occurring as well at the same time. I personally don't think it's wise, and I haven't done that in my investing journey up until this day, is to purchase where the average median growth is actually exceeding more than 50% in the last 3 years.
Yep.
Which is why I prefer to go for cooler markets.
Yeah, I'm right with you. I'm a bit of a contrarian in that context, and I'm looking with a telescope, not the microscope, when it comes to looking at properties. And for me, I talk about this all the time, but in looking at cooler markets that have the potential for growth, we're looking at the key growth drivers that are going to get behind that, and that's new infrastructure, road, rail, technology. It's new and diverse industry that's going to bring in jobs, which are going to increase the incomes that will support that growth moving forward. So that means looking at state government, federal government and local council websites to find out what committed infrastructure has been put in place. Look at zoning maps to see where the rezoning is going to occur. That's where the gold comes out. And often if you're in there early enough before that occurs, you're not fighting off the hordes of others that are caught up in the FOMO trap and then paying more than what they necessarily need to. And I guess the proviso there, of course, is that you're investing long term, because if you are a contrarian, and we know that the average time to go through a full S curve of growth is about 15 years for most areas across the country, then if you're getting in a little bit early and then riding the wave once the others finally work out what's going on, then you're much better positioned, and you're not having to fight over the hot chips with the seagulls in the meantime, with everyone else piling in. So some really good advice there, Az. I'd really appreciate it, and I really want to thank you for taking the time to give you a really quite hands-on investor-focused approach, Az. And it really reinforces the need to actually work harder and smarter if you're going to succeed in securing great properties, and particularly in competitive conditions, as well as the real need to consider fishing in calmer ponds with growth drivers away from the feeding frenzy. So thanks for coming on board to share all of this with us on the show today.
Appreciate it, Bushy. Thank you very much.
Successful property investment is a game of finance. Do you have the right team and the right game plan? Realty Talk is brought to you by Know How Property. More than mortgage brokers, Bushy Martin and his team of investment architects set you up with a sustainable strategy structured to lower your costs, tax, risk and stress while increasing your capacity for growth. Know How has helped over 1,900 homeowners and investors secure more than $800 million in property wealth. So get set to live more, work less, and live your legacy. Want to know how to invest in your freedom? Visit knowhowproperty.com.au. This is Realty Talk, powered by realty.com.au.
Now, are you one of the many increasingly disgruntled landlord investors that's getting unsettled because your property costs just keep increasing and you're constantly trying to cut back and to cut costs? Well, as you're about to hear, you may be cutting off your nose to spite your face. An author, an award-winning global property management thought leader and founder of Revolution, Jo-Anne Oliveri, joins us now to unpack her 3 decades of experience to reveal your potential false economy. So welcome to Realty Talk, Jo.
Hi, thank you. It's great to be here. Thanks for having me.
Yes, going to love the topic we're going to dive into. And I guess just to sort of kick things off there, why do you think investment landlords have never been so disgruntled?
I think what's been happening in the industry is that they have been just wanting to take on business at any cost. And that cost is a cost to the rental property owners. So they think they're saving money when in actual fact, I believe it's costing them money. And I think we need to, help them to understand it's not about the fees, it's about the net result that they earn on their property.
Beautifully said. I'd love for you to share a bit of an example that really highlights that inappropriate focus, if you can, Joe.
Yeah, sure. And I'd love to share it because, I started in the industry about 30 years ago. And, back then we were charging 8% management fees and really proud of it. And I can't think of another industry where their fees have gone backwards, and expectations have, risen. And so what we're seeing is a lot of property management companies are reducing fees to 7%, 6%, 5%, and even lower. I was with a company today and they were doing it 4%. It's like they're not making money on that.
No way.
So if they're not making money, it's actually a problem for the rental property owner.
Yeah.
And I can share a couple of examples of where you have that false sense of economy. To me, it's like when you're flying, and I fly a lot, I don't fly the economy airlines because I think it's a false sense of economy.
Yeah.
By the time I get on and pay for food and luggage and all the inconvenience of potentially cancelled flights, I save more by paying for the better fares and the better airline.
Makes perfect sense. I'd love for you to then to sort of highlight the impacts that this low fee sort of race to the bottom is actually having on investor landlords and their property performance too, if you could.
Yeah, definitely. If I do an analysis on someone who's getting around $2,000 a month in rent, so that's roughly $500 a week.
Yep.
If they were paying 5%, they would be paying roughly $1,200 a year in management fees.
Yep.
Which means that they net about $22,800. Now, that same rent, if they were paying 8% in management fees, so 3% more, they'd be paying roughly $1,920 a year in management fees, so netting $22,080. So there's an extra cost of $720. Well, that is significant. However, let's turn it around and see what happens in the second year. So in the second year, you're more likely to have rental increases set at market rent by the agent who's charging you 8%. So if we increase the rent just to $2,200 a month, so that's, like $50 a week,
yep.
which we're seeing higher rent increases than that.
Yep.
At 8%, their management fees increase to $2,112 a year, which means that they are netting $24,288. So remember, at 5%, they were netting $22,800. So now in the second year alone, they're earning an extra $1,490 odd. So that's significant. And that's the second year. And then it goes into the third year and the fourth year and the fifth year. And, I just think it's really wrong that we as an industry have focused the rental property owners, focus on fees rather than the net result. And that's where it's really important. Now, there's all sorts of other things that come along with that, in that the asset value of your property is also impacted. So, don't be tricked by low fees.
Well, if the property management office doesn't have appropriate time and resources because of the low fees to process maintenance and be careful about who they're selecting to do their contracting, then there's a whole series of other flow-on effects. Are there any others that you know of that investors need to be aware of where they are cutting costs and therefore that flow-through occurs?
Yeah, well, most definitely. I mean, one of the biggest things is the tenancy renewal. And a lot of property managers, because they're tenants themselves, they don't like sharing the news that your rent is going up. And so what they do is they have the conversations with the owners. And I'm an investor myself. So, I hire professional property managers who come to me with these conversations, and I say no when they're telling me that I'm better off not increasing the rent and keeping the tenant because they're a good tenant. I mean, what constitutes a good tenant? A tenant has to abide by the contract.
Yeah.
Just because the the bank wants to increase mortgage rates, they're not going to go to the mortgagee and say, you've been really good at paying your, mortgage every month. We're not going to increase your rate. So, we've got to have that same mindset in property management and be prepared to pay for a better agency where there's not pressure on profit, because when there's pressure on profit, what they're doing is they're bringing in property managers who are not accountable. And so, the leases are periodic. Now, no rental property owner wants a periodic lease.
No way.
Even if it's short term, then get a fixed lease, knowing that it's fixed for 3 or 4 months, because that fits into your timeline, because the tenant can up and go at any time. And so, there's pressure on the property owner, because that could be at a horrendous time to be, advertising your property. The other impacts are, like I said about the asset value of the property. It's very, very important that the asset value of your property increases, because there's no point in having it if it's being run down. And these lower fee agencies, they typically have no accountability on contractors and what's going on, because the property managers are just, like getting things done or not done.
Yes.
So, it's really important to understand that as a rental property owner, know how to hold your property management company accountable, not the person, it's the company. Yeah. And embrace the higher fees and look at the higher net returns that you're going to get as a result.
Totally agree. And I think the other hidden exercise there where you're fee chasing is that if the office isn't resourced to cover it, then there's going to be no contingency. If your property manager is sick or it has to go on holidays and there's no one to cover the base, then there's a potential world of pain that might emerge as a result of that. So look, I guess to bring this to a obvious conclusion then, Jo, what do investor landlords need to be thinking and doing differently in the context of what we've been discussing?
Yeah, well, the first thing I would advise is when they're contacting a potential management company is don't go in about the fees first. Go in and ask about the service and the results that they're achieving for their clients. Are they earning higher than the average market rent in the area? What process do they have when the property becomes vacant? Because, if they're following a process, there should be no downtime in between tenants, except for the 3 days that we allow to, do a turnover of property.
Yep.
What do they do in the event that a property manager is on leave? Because I see most companies, and, I represent the industry, and I'm just being honest here to rental property owners, where if a property manager is away, the work is not done. Yep. So, if the tenant's in arrears or if that property becomes vacant, they're waiting for the property manager to come back. And if I was the rental property owner, I'd be saying, well, are you going to refund my fees for that time? Because no one was managing my property. So, I would love for rental property owners to know how to hold their property management company accountable and get the results that they should be getting on their properties.
Yeah, extremely well said. Well, look, I really want to thank you for making it real for us, Jo, in terms of the negative financial impacts of adopting a sort of a lowest common denominator focus on fees on costs versus focusing on service value and profitability, because as I always say, you always get what you don't pay for. So thanks for sharing this with us and joining us on the Property Hub today, Jo.
My pleasure. Thank you.
Are you curious about harnessing your super for property investment? Propel your future with the enlightening online seminar, The Ultimate Masterclass to Self-Managed Super Fund Property Mastery. Reserve your spot now at getrare.com.au/SMSF. Spearheaded by Rusty from independent buyers agency Get Rare Properties, this masterclass unravels strategic property investment using your self-managed superannuation fund. It's not just about learning. It's about transforming your financial future through education. So embrace this opportunity to enrich your investing acumen. Enroll now in the free masterclass and begin a journey that marries insight with action, leading to a financially empowered tomorrow.
Unlock bonus content now as a premium subscriber.
Join us for more property news each week with Realty Talk and get invested by subscribing to the Property Hub on all podcast players. Join the conversation on Facebook. Just search the Property Hub Collective and give us a like and follow. Thanks to our supporters and content partners, realty.com.au, BMT Tax Depreciation, Know How Property Finance, Get Rare Property, and Apiro Marketing. Until next week, all the best.